Committee meeting of September 21st to order, and I believe it's an insurance update today. Bob?
Thank you, Mr. Chair, members of the committee. Bob Samario, Finance Director. And yes, we are going to be talking about insurance. And, the city does a lot of things, involve a lot of activities, important activities and services. But one of the things that we have to do kind of in our department that really doesn't get a lot of attention but is very, very important is to make sure that the city is protected from risks and other exposures. And, we haven't come to the council or finance committee in a long time, and we typically would do this every couple of years, but I think it's been more like 4 or 5 years. And we just think it's a good idea periodically to come to you and remind you of what we do in terms of protecting the city from an insurance perspective, but also to describe the programs we have and to bring you up to date on the types of coverages we have in terms of limits and how much we pay for those kinds of coverages. And so we just wanted to bring this to you today. And Mark Howard, who is our interim risk manager, acting risk manager, he's going to be presenting you all the details of our programs. There's a big report in the agenda, a lot of discussion. We're not going to get into all of that, but just highlighting the key things that we do, workers' comp, liability, and property and insurance and the like. So, but feel free to ask questions on anything else that's included within the report. But with that, I'll just turn it over to Mark, and he can start.
Thank you for joining us today, Mark.
Pardon me?
I just said thank you for joining us today, Mark.
It's my pleasure. We have a brief overview, and then we'll get into some of the finer details of what the program entails. So what we're going to be talking about today is the history and background of the self-insurance fund, elements of the program, how we fund it, and then we'll get into some of the details, program details on specifics in workers' compensation, general liability, and property and the miscellaneous insurance programs. From a historical perspective, the self-insurance fund was created in 1974 to originally account for the workers' compensation program. Action by council created that in 1974. It was amended in 1976 to add the general liability program. So self-insurance programs and the insurance costs are accounted for in an internal service fund that's budgeted each year as part of our annual budget. This change going to self-insurance was part of the city's response to changes in the insurance market. As you may be familiar, and we'll talk about this as we go forward, the insurance market has tendency to go in waves where insurance is what they call a hard market, unavailable or very expensive coverages, to a soft market where all kinds of coverage is available at very affordable pricing. And in the early 1970s, it was an extremely hard market, and municipalities, including Santa Barbara, were finding it difficult to obtain insurance at pricing that they could reasonably afford to pay. So they took on self-insurance as a way to reduce some of those overhead costs. So that's what we're doing here. Is this going to work? We were having difficulties with this earlier, and it seems to have returned. There we go. We got it moving, except we went a little too far. I think we went too... So the risk management collects premiums, which are funds directly from each of the... Oh, now we went too far again. So workers' compensation program provides benefits to injured employees in accordance with federal and state law. We do have a couple of operations where if an employee were injured doing that, we would fall under the federal format of workers' compensation, not California law. Liability program where we investigate incidents and adjust damage claims and correct potential hazards, and loss prevention, including defensive driver training courses. We have an occupational safety and health program, which under Cal OSHA we are obligated to provide a safe work environment, and we ensure that through training, medical screenings, and safety analysis, and that includes monthly trainings on our IIPP, or our Injury and Illness Prevention Program. The insurance program, or the self-insurance fund, currently fiscal year 11, $5.47 million budgeted, 75% of that goes to claims and insurance. This slide may seem familiar. You may have seen this presented to the council before when Bob presented part of the budgetary process. But you'll see that workers' comp claims encompass about 30%.
I'm sure my committee members remember exactly every pie chart you've ever shown us, Bob.
I'm sure they do. Liability claims and insurance about 23%, property insurance 22%, salaries and benefits 12%, and then allocated costs and supplies and services make up the balance. We will talk in detail a little bit further on each of these things and where the costs go. So each operating fund, including enterprise and other restricted funds, pays a premium to the self-insurance fund based on its payroll, fleet of vehicles and vessels, boats, barges, and the like, and also the buildings that it occupies or has control over. Risk management then collects these premiums and uses those to pay claim costs, sponsor loss control programs to reduce frequency and severity of claims, and purchase a limited amount of commercial insurance. So we'll get into first the workers' compensation program. And the city is self-insured for the first $750,000 per claim for the current fiscal year. This amount may vary year to year based on, once again, what the insurance market is doing and whether we want to self-insure more or less based on the cost available to us. The city is part of a joint powers authority known as CSAC, and for those looking for that actual acronym, that's the County Supervisors Association of California Excess Insurance Authority. Very long name, but great little acronym. That joint powers authority will pool losses above the self-insured retention up to $1 million. So we are one of 190-some entities, 54 counties and several other cities, special districts that are part of the JPA, and we will pool our losses from that self-insured retention up to $1 million. That way we can spread the risk amongst all those other entities, so that the thought being that none of us are going to have a loss that exceeds our self-insured retention at the same time and hit us all for a big hit. This way we can spread that risk over a greater number of people. The Joint Powers Authority purchases excess insurance above $1 million, and that is purchased through the CSAC group, and for that we pay a premium to CSAC in fiscal year 2011 of $152,000 for that excess insurance. This is a look at our claims history, looking at costs going over a 10-year period, beginning in fiscal year 01 through fiscal year 10, the fiscal year that was just completed. And you will see that claim costs have gone down, and that trend continues through fiscal year 10. There are a couple of things that led us to get to these wonderful results, not the least of which were some legislative changes in 2004 that changed how workers' compensation is, the benefits that apply. That eliminated several benefits and also allowed us to, for the first time, apply what we call apportionment, so that if somebody has an injury, an employee has an injury, and that injury results in permanent disability, we only pay the amount of permanent disability that's attributable to that injury, not any other injuries that they had to the same body part before that injury happened. Big change. That happened in 2004, and you can see what that's done to some of our loss history here.
Bob, can I ask you sort of also to, what was the size of the general fund budget back in, at that time? So, year 2001, 02.
Mr. Chair, I don't remember, but my guess is it would have to be somewhere in the 80s or 90s, maybe low 80 million range for general fund.
So essentially, we've gone from about 5% of our cost going towards workers' comp to 0.8%.
Right.
0.5 to 0.8%.
And that's correct.
That's
And
a huge difference.
the only thing I would add to that is that the $3 million and all the way down to 800,000, that's all claims but then we're for workers' comp across all funds. So it's not just a general fund, but it's enterprise funds and the like. So this is citywide. And again, just to
So it'd be more like
Yeah.
from 2.5 to 0.35%.
exactly. Right, and these are the claims costs within the SIR, not the portions that are covered by insurance. So these are just the portion that we actually paid out of pocket through our self-insured program.
And moving forward, the next screen shows our claim frequency, the number of claims reported in each fiscal year. And this is also part of the reason why we're seeing the better financial results. As you'll see, in 2001, we had 209 claims reported. In fiscal year 10, we had 128 claims reported. When we look at the average number of claims reported historically, going back to 1978 when we really started the in-house self-insured portion of the workers' comp fund, that average is 250 claims. So in fiscal year 10, we are about half of our historical average. Fewer claims will mean less costs to the program. And this is really a function of our operating departments really being more aggressive in their safety programs. So part of the loss prevention and loss control that we do through the Risk Management Office is the Injury and Illness Prevention Program, our IIPP, which are policies and procedures about safe work practices to comply with Cal OSHA standards. We have IIPP training, which happens monthly. There's at least one, and oftentimes more than one, topic for training. Medical screening for specific operations that require that, things such as respirators, infection control, and the like. And our Return to Work program. That Return to Work program has also greatly impacted our better results. In the last several fiscal years, using the modified duty program, we have seen reductions in claim costs on the workers' comp side from, in fiscal year 07, $545,000, fiscal year 08, $430,000 reduced, fiscal year 9, $320,000 reduced, and last fiscal year, $236,000 reduction in our workers' comp claim costs using that program. We also have citywide safety committees, and each department has a safety committee. These committees will review the injuries that are reported and identify ways to improve our work practices and procedures to prevent these injuries from happening again. So the issues and considerations we have to look forward to, the city is insulated from instability in the workers' comp market due to its participation at CSAC. With our $750,000 retention, we may change that based on pricing. We may see some of those costs in our pool layer, as I mentioned before, in the JPA pool layer. There are a few claims that have been reported by other entities that have pierced that level that are quite large, and as those claims continue to develop, we may see those costs increase 5 to 10% in the coming years. And with that, we move on to the general liability program. Again, the city is self-insured for the first $1 million. We do participate in a JPA called Excel. We were a founding member of Excel back in 1985, 86. In the mid-'80s was another hard market for the insurance market, and the city found it very difficult to purchase excess insurance above its $1 million self-insured retention. And we joined, at that time, a group of 6 cities to create this JPA. The Excel membership is now up to 11 members. So with that, we are able to spread our risk even further. So the likelihood of all 11 members having a loss that exceeds our $1 million self-insured retention is possible, but not likely in the same given fiscal year. This way, when somebody does, it doesn't hit us as hard as if we had nothing but ourselves to go by. We pool losses in that JPA for losses above the SIR of $1 million up to $5 million for a grand total of $4 million pooled. And then we purchase excess commercial insurance above that up to $50 million. So the premiums that the city paid in fiscal year 11, $515,000 covered the pooled amount where we're sharing risks with the 10 other cities, and then $225,000 for the excess insurance up to the $50 million level. The program details for the general liability program, they adjust the claims. General liability claims, examples, trips and falls, sewer backups, water main breaks, damage caused by city staff, automobile liabilities. They also do some loss control. We have an internal fix-it program where people will contact risk management and report hazards that they see to city-owned property or facilities. And we will report that to the department who has responsibility for that and get that corrected within a reasonable period of time. The general liability program also sponsors fleet safety. Once every year in March, we do defensive driver training classes for people who operate a city vehicle. They also check driver's license to make sure everybody has a current driver's license and any restrictions that it may have. And here's a look at our claim costs for the general liability program. 10-year look, beginning in fiscal year 01 through fiscal year 10. And you can see that there are some rather large numbers. And we've had some large losses over the years. And many of those, for example, in fiscal year 3, actually fiscal year 2, we had some losses that are atypical. Personnel losses, civil rights claims that are not typical losses that we see. The typical losses that we see would be vehicle collisions, trips and falls, sewer backups, water main breaks, those types of things. The atypical things, personnel actions, civil rights or police claims, and weather-related claims. And you'll see that when we have some of those atypical things, fiscal years 2, 3, 4, we see higher claim payouts. When we look to the frequency, we see that our frequency is going down. As I said before, the typical types of claims, vehicle and fleet claims make up about 20% of our claims. Trips and falls make up another 20%. Sewer backups about 15%. And water main related claims another 15%. However, the water main claims over the last 5 years have dropped to about 3%. That's one of the reasons we're seeing a lot of these claim numbers go down. I can attribute that to much of the capital improvement programs where we're replacing a lot of older water mains. We're also seeing fewer high-dollar vehicle claims. I'm attributing that to part of our prevention programs where we review in the safety committees all workers' comp injury claims and vehicle collision claims for a preventability analysis. And the more we've focused on that, we're getting fewer of those, as many people call them, oops, it was a mistake type of claims with the associated dollar costs that go with them. This screen is a little bit difficult to read on the PowerPoint. However, it's here to tell you where our coverage limits have been, both our self-insured coverage and the amount of total coverage available since we joined Excel. And as you can see, other than a 3-year period or 4-year period of time from fiscal year 2000 to 2003, we've had $1 million self-insured retention. In 2000 to 2003, it dropped to $500,000 when the economy was going quite well, and we were able to reduce that down to $500,000. But you'll also see that coverage limits began at $10 million and have increased incrementally over time to where they are currently at $50 million. So the issues facing the general liability program, the excess insurance market continues to be relatively flat the last couple of years. The primary insurance market remains unstable, with many carriers underwriting the policies lower than what they probably should, trying to purchase more market share. Excel, our JPA, continues to solicit bids on the primary insurance layer, and we may or may not change that self-insured retention depending on how that market continues to pan out. We are currently seeing that the Excel rate for risk sharing within that $1 to $5 million range is still lower than the actuarial expected levels, so the likelihood of us being able to buy that insurance doesn't look promising in the short term. Moving along to property insurance. The city owns a variety of property, anything from city hall to fire stations, police stations, park buildings, and they purchased an all-risk property insurance that covers more than 380 buildings that the city owns. The city does not purchase insurance to cover everything it owns, things such as infrastructure like streets, sidewalks, bridges, those types of things. We do not insure. We do purchase an all-risk policy, which covers pretty much what it says, all risk, with it a few exclusions, the major exclusion being earthquake. In fiscal year 11, we were able to expand the coverage to include this new coverage for cyber coverage for things that might go wrong with computer records, as well as adding an upgrade to green building code statutes that wasn't available previously. Total insured values for those 380 buildings is just more than $390 million. We were able to successfully reduce our deductible from $100,000 in fiscal year 10 to $50,000 for fiscal year 11. That's for all the buildings except for Stearns Wharf. Stearns Wharf has a deductible of $200,000. Yes, because of our loss history, it's at $250,000. The limits of our property insurance are $1 billion total, and our premium this year for fiscal year 11 was $407,000 for that coverage.
Let me just ask a question. $250,000, that's got to be a huge financial burden on the waterfront. It's a big part of the budget. That's a significant chunk, is just to insure Stearns Wharf. Wow.
That's the deductible.
Oh, the deductible, sorry.
Yeah.
It's not the amount every year.
Right.
Got it.
So it is covered as part of our $1 billion in limits of coverage.
So it's the risk that we, if it burns yet again, which it will someday, we've got to pay $250,000.
The first $250,000. And we'll talk about that in the slide coming up. So for this year, we paid $407,000 for property insurance under the all-risk coverage. So what are the issues and considerations? Well, a couple of the issues are actual values. Not all of our buildings have been appraised within the last 10 years. And what that means is as we do more appraisals, the values of those buildings increase, so the cost of our total insured values go up, the cost of insurance will go up with it. Identifying what we want to insure. Do we want to go beyond what we've done historically, which is just the major buildings, and add things that on that list that I had before of things we don't insure? We could insure those things, but there's going to be a cost involved with that, and where is our desire for cost savings? We come to our risk appetite, and this is what our chair was just talking about with Stearns Wharf. Yes, we can get a lower deductible for Stearns Wharf, but at what price? We know that that structure has a tendency to burn, and when it does, it's expensive. And we can lower that deductible as well, but it's going to cost us more for that premium. And then we come to the market restraints, the things that have burdened this program and will continue to burden it forever, and that is whether it's a hard market or a soft market, what coverages are available, and at what price. Moving on to earthquake, we have total insured values under the earthquake program of $443 million, a deductible of 5% subject to a $100,000 minimum, limits of $50 million. And this is something that's separate and distinct from our all-risk property coverage. So if we were to have an earthquake event in our local area, we would have dedicated limits of $50 million to use at our disposal, and what we choose to rebuild first. In other words, just because we have 380 buildings listed on our property schedule, we can choose where that $50 million gets spent first. And I'm sure that the city administrator and council will be deciding what are our most important buildings and where do we start based on what happened in that event. So, for example, if the event happens and we lose a majority of the buildings at Cater Water Treatment Plant, the likelihood is that we're going to use our $50 million to start rebuilding there first before we start rebuilding Chase Palm Park. So just for an example. And that earthquake premium this year, fiscal year 11, cost us $676,000, much more than our all-risk policy.
Can you go back more
Sure.
to that? Just, I just want to absorb this a little bit more. No, the earthquake slide.
The earthquake slide? Okay.
So we have insured $443 million of our property.
We've identified 387 buildings that have an approximate insured value of $443 million.
And if an earthquake happened, we would pay for the first $50 million.
No, if an earthquake happened, we would have $50 million in coverage available for us to use to rebuild whatever we need to rebuild at our selection.
And so what would we pay for? What would we pay for?
We would pay 5% or $100,000 for rebuild before insurance starts paying a dime. So it's much like if we had an earthquake and it was localized and leveled Cater Treatment Plant. And Cater Treatment Plant has...
Right, I got it. So 5% of 443 is...
no, 5% of the loss.
Right. So if the loss exceeded the
So if the
amount
loss
of
was
value-
$10 million, we pay 5%,
Right.
$10 million. Or if it was less than $10 million, if we have a minimum of $100,000 we'd
Right.
have to pay. But it's 5% of the loss.
And for that coverage, we pay $676,000 a year.
Correct. Okay. Now, the issues and considerations. If we were to have a major earthquake event, we could expect assistance if there was a disaster declared either state or federal by FEMA or CalEMA. However, their response is going to be a little slower than what our local citizenry would prefer us to do. And that $50 million worth of coverage allows us to get up and running before FEMA or CalEMA funds would be made available to us. There is a requirement under FEMA that once there has been an event that causes damage to an insured facility, and that insured facility received some reimbursement from FEMA, that we must maintain coverage on that building in perpetuity if we expect FEMA to come back a second time. So using that example that we used before, we have a major event, and we used our $50 million to work at Cater Treatment Plant or El Estero Plant or whatever we feel are the most important buildings. We will have to then dedicate some of our limits to covering those buildings going forward in the event of a subsequent earthquake sometime down the road. The next issue in consideration are our coverage limits. We have selected $50 million in coverage limits based on two studies that we had done in the past year of potential maximum loss. One showed a potential maximum loss of around $66 million. The other one showed a loss at $38 million. We did an average and stuck with the 50. As the coverage becomes more difficult to obtain, we may have to relook at where we stand. Is $50 million appropriate, more or less, as the market hardens and softens? And I'm sure we'll be taking direction from this group as to where we need to go with that. And this is just a quick look at where we spend our insurance premiums by line of coverage. You see that property insurance makes up 56% of total premiums paid, liability 34%, while workers' comp is only 7%, and other lines of insurance 3%. Total premiums paid in this fiscal year, $2.1, almost $2.2 million. The other lines of insurance that we do purchase specialty insurances for include airport and aviation, for those operations at the airport that have a unique exposure that we just don't want to include in our Excel program because they're excluded. Marine liability, which covers our fleet of floating vessels. And then employee dishonesty or crime policy, we are mandated by state law to cover certain job titles for this, and including city administrator, treasurer, city clerk. Finance director, yes. And with that, we concluded our overview presentation. Any questions?
Questions from the committee? Mr. Francisco.
Thank you. Mark, just if you happen to know this off the top of your head, which job categories tend to be the most at risk for injury? And if you don't know that off the top of your head, we can talk about it later.
Councilmember Francisco, I don't have information about job classifications. I can tell you where which departments are having the most injuries. And in the annual reports that we've done for the departments and city administrator going back several years, there's the top 4 departments that have the most claims year in, year out. Police Department and Public Works vacillate 1 and 2, followed in order with 3 and 4 vacillating between Fire and Parks and Rec. Those are where we're having the majority of our claims.
Okay. Thank you.
Other questions? Councilmember Self.
Thank you. When you were talking about building insurance, and this insurance is probably very different than homeowners, but depending on the insured amount, a certain percentage of that is put towards interior things if they're damaged in a fire. Do we have that? Is that also in this commercial insurance? Or
Councilmember Self, our all-risk property insurance does cover losses, including personal properties within the building that are resulting from that peril.
right.
So if there was a fire and we lost tables and chairs and computers, that would be covered.
Okay. And then one other question. I understand that and rightfully so, that the departments are charged for their share of the insurance. Is it by the number of employees that they have that they are charged for the risk, their premium?
The premium allocation is based on several factors. So for the workers' compensation program, that's based on payroll. For liability, it's based on payroll and the number of fleet items in that Department of Funds fleet. For property, it's based on the total insured values that fund or department operates or occupies.
Very good. Thank you.
You're welcome.
Just
Councilmember
Just
Francisco.
to follow up on that question, because this reminds me of something I was thinking about earlier. So when you say it's based on payroll, do you mean strictly the number of employees or some combination of the risk factor for particular kinds of employees?
Councilmember Francisco, it is a combination of the number of employees and the actual payroll dollars, the exposure dollars that we pay to that employee for salary.
Okay.
Any other questions? And this is just an update. You have no action item for us today.
That's correct.
And just one clarification, that for workers' compensation, there is a factor involved based on the type of work they do in general categories, but it doesn't go down to specifics.
Okay. Well, that was important information because obviously what we need to be prepared for is the idea that some of these premiums are going to go up. And we either need to make the decision of scaling back some coverage or spending more on insurance. Is that essentially why you're bringing this to us is this is something that we're going to have to wrestle with in future budgets of which way to go?
That's correct. That's correct. And I do want to point out that in addition to the coverage, we also have a policy for reserves covering disasters. So if we have an earthquake or any kind of other event like that nature, we do have some money that we would be able to use in addition to any monies we get from insurance immediately while we're waiting for a response from FEMA or CalEMA And as you know, it's 15% for our general fund and enterprise funds, and I think on a combined basis, it probably represents close to $50 million. So we do have some cash that we're setting aside for those purposes, and each fund would be able to utilize it, and we wouldn't necessarily have to dedicate it to, for example, the general fund had a bigger need than the enterprise funds, but there was less disaster impact there. We could take some of those money, at least borrow it in the short term if necessary, some of their disaster funds to respond. So we do have cash citywide to respond. That's pretty substantial for disasters. So that just supplements what Mark was talking about from an insurance perspective. So it's also important to recognize.
Okay, with that, I'll adjourn the meeting. Thank you so much.